Welcome to this explainer. Okay, let's dive into this, because this is something that has always fascinated me. Have you ever looked at the world of personal finance and noticed a totally baffling paradox? Why is it that some people who make an absolutely massive income end up completely broke, while others, people earning just an average everyday salary, somehow manage to quietly become exceptionally wealthy? It's a puzzle, right? It goes against literally everything we're taught about how money is supposed to work. So today, we're decoding that puzzle. We're looking at the behavioral economics and the psychological realities of financial behavior. We're going to explore exactly how successful investors just think differently from the rest of the pack. Because at the end of the day, building wealth is rarely about the math. It's almost entirely about how your brain is wired.
It really does look like a typo, doesn't it? High income, broke. Average income, wealthy. We are culturally conditioned from day one to believe that your net worth is tied directly to your salary. But think about it for a second. If making more money was the only secret to wealth, well, every high earner would be rich and every average earner would be struggling. But reality shows us the exact opposite, every single day. The real differentiator? It isn't the raw cash flowing into their bank accounts. It's their underlying financial psychology. The way you perceive money, the emotional triggers you react to, and honestly, how you behave with what you keep, that matters vastly more than what your paycheck actually says.
And that brings us to what I think is the biggest roadblock holding most people back, the myth of finding the perfect stock or crypto. We've all seen those flashy headlines, right? We've all heard the crazy stories of someone throwing a few $100 into some random meme coin and waking up a millionaire. It creates this pervasive, kind of toxic misconception that successful investing is just a get-rich-quick game, all driven by the intense dopamine hit of picking the perfect asset at the exact right time. It totally frames investing as this high-stakes treasure hunt. But listen, if you treat the market like a lottery ticket, relying entirely on luck, timing, and chasing that next big rush, you are mathematically and psychologically guaranteed to lose over the long haul.
So, let's wipe that myth away right now. The absolute biggest factor in your financial success is your mindset. Sounds simple, I know, but it is unequivocally the hardest thing for a human being to actually master. The reality is, successful investors don't have a magic crystal ball. They don't have a secret hotline to Wall Street insiders. What they do have is an iron grip on their own psychology. They prioritize emotional control above literally everything else. They inherently understand that the exact moment you let your feelings, whether that's, unbridled excitement, deep-seated fear, or just blind greed, the moment those drive your decisions, you've already lost the game. True wealth builders operate on logic, rigorous systems, and unyielding discipline.
To really understand what that discipline looks like, we have to look at the psychological traps that destroy even seasoned investors. Mistake number 1, herd mentality. That's buying an asset just because everyone else seems to be buying it. Evolutionarily speaking, we're wired to follow the herd for safety, right? It kept our ancestors alive. But in investing, it's absolute financial suicide. So I want you to be perfectly honest with yourself for a second. Have you ever made a financial move just because a trending narrative, or maybe a frantic group text, made you feel like you were missing out on the opportunity of a lifetime? When you buy just because of the crowd, you aren't investing. You're just participating in a psychological stampede. And historically, by the time the crowd is roaring, they're almost always late to the party.
And man, when that crowd inevitably turns around and runs the other way, we hit mistake number 2, panic selling. Just picture this. The market opens. The lines are instantly flashing red. The news headlines are screaming about an unprecedented, catastrophic crash. Your portfolio drops 10%, then 15%. Your heart starts racing. Your palms sweat. This is your brain's loss aversion kicking in real time. It's that psychological reality that losses hurt twice as much as gains feel good. You feel this primal, desperate urge to just hit the sell button so the anxiety will stop. But here's the crucial point. When you give in to that amygdala hijack and sell out of fear, all you're doing is taking a temporary, paper drop in price and locking it in as a permanent, irreversible loss. You are letting a temporary feeling dictate a permanent financial outcome.
Which leads us straight into the final and maybe the most seductive emotional trap. Mistake number 3, chasing quick profits. We are biologically wired to crave immediate gratification. We want the reward, and we want it the second we put in the effort. In investing, this shows up as prioritizing immediate, short-term gains over steady, long-term growth. It's constantly jumping from one hot sector to another, trying to perfectly time the market to make a quick buck. The real tragedy here is impatience. By constantly chasing the illusion of an overnight win, people continuously pull their plants up by the roots just to see if they're growing. And by doing that, they disrupt the incredible power of compound interest. Actually, scratch that. They completely derail it. They sacrifice massive future wealth for a fleeting dopamine hit today. So let's synthesize the sheer wreckage caused by these three traps. Because whether it's following the crowd into a massive bubble, panic selling at the absolute bottom, or wildly chasing quick profits, the exact guaranteed outcome is always the same: financial loss. And this brilliantly illustrates the core mechanics of wealth destruction. Look, it isn't the broader market that takes your money. It isn't the macroeconomic environment, and it definitely isn't the government. It is your own lack of psychological discipline. Every single time you allow fear, greed, or impatience to override your rational, predetermined plan, you are quite literally transferring your own wealth directly to someone else out there who managed to keep a cool head.
Okay, so how do we completely flip the script? Take a deep breath. Let your heart rate slow down a bit, because the Smart Investor's playbook, it is delightfully, intentionally boring. Following a plan, investing consistently, staying patient, diversifying, focusing on long-term goals. There's no adrenaline here, guys. There are no flashing red and green lights triggering your primal instincts. Smart investors actively, consciously choose to ignore the chaotic daily price movements that drive everyone else completely crazy. They don't check their portfolio every 5 minutes, they set a strategic plan based on solid, fundamental principles, and then they execute it with ruthless, almost emotionless consistency month after month, decade after decade.
It all fundamentally comes down to shifting your entire worldview from wealth overnight to wealth over time. The emotional amateur is hopelessly obsessed with wealth overnight. They view the market as a frantic sprint, desperately hoping to cross the finish line by next Tuesday so they can quit their job. But the smart investor, they live firmly in the quiet reality of wealth over time. They inherently understand that true, sustainable financial success is a long marathon. It requires completely shifting your focus away from that ravenous hunger for immediate gratification. It's about accepting that real wealth accumulation is a slow, steady, and highly disciplined process. Honestly, it's simply about setting up the right system, stepping back, and letting time do all the heavy lifting for you.
So how do we actually implement this in our daily lives? It really breaks down into two profound behaviors that you have to actively build into your routine. First, controlling your emotions. You have to build a friction point. Before you hit buy, before you hit sell, force yourself to pause. Ask yourself honestly, am I doing this because of a sudden feeling or because of a hard fact? Second, making informed decisions. And I mean decisions based purely on your personal financial goals and rigorous research, not on what some talking head just yelled about on television. Mastering these two habits isn't just a small part of investing, it is the entire game. It is the only true illuminated path to building lasting generational wealth.
As we wrap up this explainer, I want to leave you with one final thought to deeply reflect on. Are you just investing in stocks, or are you investing in your mindset? The market is always going to be deeply unpredictable. The global economy will always have terrifying downs and euphoric ups. That's just a fact. But the only variable in this entire equation that you have absolute 100% control over is you. Your psychological discipline is without question your greatest financial asset. Cultivate it, rigorously protect it from the noise, and let it guide you. Thanks for joining me to explore this vital topic today, and keep focusing on building that unshakable mindset.